50 years old, and it feels like everyone else already crossed the finish line. You open your phone and see another person your age living off dividend income. Then another headline about someone who reached 7 figures before turning 35. Before long, the same thought starts playing in your head. I waited too long. That opportunity is gone. Meet Gary. Gary just turned 50. He has a solid job, his mortgage is more than halfway paid off, and there's about $41,000 sitting in his 401k. The problem? He barely looks at it. Every time he opens the account, he's reminded of how far behind he thinks he is, so he closes it again. Gary has an old college friend named Curtis. Curtis started buying dividend stocks at 25 and never stopped. A while back, Gary compared Curtis's portfolio to his own and calculated what that 25-year head start was worth. After doing that math, he stopped opening his retirement account altogether. But here's what Gary doesn't know yet, and what we're going to prove with real numbers, not empty motivation. The IRS tax code has quietly created one of the biggest opportunities in decades for people exactly Gary's age. He's not out of runway, he just hasn't been shown where the runway begins. By the end of this video, you'll know 3 things. First, the exact IRS contribution limits designed specifically for people getting a later start, including a 4-year opportunity that most 50-year-olds have never even heard of. Second, a simple formula you can use with your own numbers to calculate exactly how much you need to invest each month, whether you're starting with nothing or already have $50,000 saved. And third, the one mistake that costs late starters far more than starting late ever will. But before we get into all of that, let's start with one number that should make you feel better, not worse. Here's the headline. If Gary wants to generate $2,000 a month in dividend income on top of Social Security by age 65, he'll need a portfolio worth about $400,000, assuming it eventually reaches a 6% yield on cost. That's 15 years away. Starting with his current $41,000 balance, he'd need to invest a little over $1,000 per month between his 401k and a Roth IRA to get there. At first, $1,000 a month sounds overwhelming, but here's the part most people miss. The IRS actually designed retirement accounts to let someone Gary's age contribute far more than that. In 2026, someone who's 50 can put away up to $2,708 per month into a 401k alone, before even considering an IRA. Gary isn't running into the contribution limit. He's running into the belief that the opportunity has already disappeared. It hasn't. And in the next few minutes, you'll see exactly why. And exactly how that goal of $2,000 a month can become a realistic retirement plan instead of just wishful thinking. That target only makes sense once you understand how much room the tax code actually gives you. Because most people in their 50s are still planning around the contribution limits they learned 20 or 30 years ago. Think of this as the catch-up runway. And it has 2 lanes. The first lane opens the year you turn 50. For 2026, the standard employee contribution limit for a 401k, 403b, or governmental 457 plan is $24,500, according to IRS. Notice 2025-67. Once you reach age 50, you're allowed to contribute an additional $8,000. There's no separate application. No special account. You simply elect the catch-up contribution through your employer's retirement plan. That brings your total annual contribution limit to $32,500, or about $2,708 every month, into a single 401k. But the second lane is where things get really interesting, because almost nobody in Gary's position knows it exists. It's brand new. Under the Secure 2.0 Act, workers who are 60, 61, 62, or 63 years old receive an even larger catch-up contribution. Instead of an $8,000 catch-up, they're allowed $11,250 as confirmed for 2026 in the same IRS notice. That increases their total contribution room to $35,750 per year during those 4 years. Once you turn 64, the limit drops back to the standard catch-up amount. In other words, the tax code creates a dedicated 4-year window specifically for people approaching retirement who need to accelerate their savings. Congress essentially recognized that not everyone starts investing in their 20s. Some people need extra room later in life. If you're 50 today, that window is still about a decade away, which means you have 10 years to build your foundation before reaching the period when you can save even more aggressively. There's one more detail you should know before setting anything up. Starting this year, if you earned more than $150,000 in wages last year, Your catch-up contributions have to go into a Roth account instead of a traditional pre-tax account. You don't get to choose. That's not a penalty. It simply changes when you pay taxes, not whether you pay them. So if you're in that income range, it's worth planning ahead, instead of finding out from your HR department at the end of the year. Now you've seen the runway. But having a runway doesn't help much if you don't know how fast you need to move. So let's fix that. Here's the formula. It's the exact same calculation behind Gary's goal of generating $2,000 a month in dividends. The difference is that now you'll be able to plug in your own numbers. I call it the catch-up number, and it only takes 2 steps. Step 1 is simple. Take the monthly dividend income you want in retirement and multiply it by 200. That gives you the approximate portfolio size you'll need. Why 200? Because it assumes your portfolio eventually reaches around a 6% yield on cost after many years of dividend growth and reinvestment. That's not the yield you'd expect on day one. It's what a mature dividend growth portfolio can realistically produce after a decade or more of companies consistently raising their payouts. So if Gary wants $2,000 per month, his target portfolio comes out to roughly $400,000. Now for step 2, figure out the monthly contribution needed to grow from where you are today to that target. For this example, we'll assume an average annual return of 8% while you're still building the portfolio. That's intentionally conservative. It's below the S&P 500's long-term historical average because I'd rather underestimate than promise unrealistic results. Now this is where things become personal. Your starting balance changes the math more than almost anything else. Let's look at 3 different scenarios. Each person starts at age 50. Each wants to retire at 65. Each has the same $400,000 goal. The only thing that changes is where they're starting. Scenario 1. You have nothing saved. $0. To build a $400,000 portfolio over 15 years with an 8% annual return, you'd need to invest about $1,156 per month. That's still comfortably inside the annual contribution limit of a single 401k, leaving you with roughly another $1,500 per month of available contribution room if your budget allows. Scenario 2. Now let's say you've already saved $50,000. Maybe it's sitting in an old 401k. Maybe it's in a rollover IRA. Maybe you've simply ignored it for years. Left alone to grow at 8% for 15 years, that $50,000 becomes roughly $165,000 without adding another dollar. Now your remaining gap isn't $400,000 anymore. It's closer to $235,000. That drops your required monthly contribution to around $678. That's a huge difference. Just having that existing balance cuts the monthly savings requirement by hundreds of dollars. Now let's look at one more example. And honestly, this one surprises a lot of people. Scenario 3. You already have $150,000 saved. That might sound unrealistic at first, but it actually isn't. According to the Federal Reserve's Survey of Consumer Finances, the median retirement account balance for households between 45 and 54 is around $115,000. For households between 55 and 64, it's about $185,000. So $150,000 sits right in the middle of those ranges. It's not some fantasy scenario. Now watch what happens. If that $150,000 grows at an average of 8% for 15 years, it ends up at roughly $496,000. That's already above Gary's original $400,000 target, without contributing another dollar. Everything you invest from that point forward simply gives you a larger margin of safety, or a higher retirement income. Not because you have to contribute more, because every extra dollar now becomes an accelerator instead of a necessity. The important lesson here isn't that everyone already has $150,000 saved. It's that your current balance matters far more than most people realize. Don't assume you're behind. Run your own numbers. You might be much closer than you think. And if you'd rather not calculate everything by hand, there's a free dividend snowball calculator linked in the description. It uses this exact formula with your own starting balance, contribution amount, and income goal. If you want even more automation, including contribution tiers, dividend projections, and tax calculations, that's exactly what the Dividend Income Toolkit was built for. Once your money starts working every month, the next question becomes just as important. Where should it go? Because this is where most beginner investing videos stop. And it's where some surprisingly valuable tax advantages begin. Let's call this next idea the 1990A discount. It's something that becomes especially relevant once you've filled up your tax-advantaged retirement accounts and start investing additional money in a regular taxable brokerage account. This is where REITs come into the picture. Real estate investment trusts, or REITs, are required by law to distribute at least 90% of their taxable income to shareholders. That's one of the main reasons they often offer higher dividend yields than traditional companies. As of the end of May 2026, the FTSE Nareit All Equity REITs Index was yielding about 3.65%. Of course, that number changes with the market, so if you're researching REITs yourself, always check the latest data. Now here's the trade-off. Unlike most qualified dividends, REIT dividends are generally taxed as ordinary income. For years, that made many investors think REITs belonged only inside retirement accounts, but there's a tax rule that changed the equation. And surprisingly, a lot of investors still don't know about it. In July 2025, the One Big Beautiful Bill Act permanently extended the 20% Section 1998 deduction for ordinary REIT dividends. Originally, this tax benefit was scheduled to expire. Now, it isn't. That means a portion of your REIT dividend income is automatically deducted before your federal taxes are calculated. If you're in the highest federal tax bracket, that reduces the effective tax rate on REIT dividends from 37% to roughly 29.6%. If you're in a lower bracket, the same 20% deduction still applies. The percentage doesn't change, your tax bracket does. And the best part? There's nothing special you have to do. Your brokerage reports those payments as Section 1990A dividends on your 1099 DIV, and your tax software handles the deduction automatically. It's not some complicated loophole, it's simply a permanent feature of the tax code that makes REIT income more tax efficient than many investors realize. Now, that doesn't mean your entire portfolio should be REITs, far from it. Most people getting a late start don't build successful portfolios by picking dozens of individual stocks. And honestly, they don't need to. One of the strongest long-term records in dividend investing comes from the S&P 500 Dividend Aristocrats. Today, that index includes 69 companies, each of which has increased its dividend for at least 25 consecutive years. Think about what that means. These companies didn't just survive good markets. They kept raising their dividends through recessions, financial crises, market crashes, and everything in between. For someone who's 50 and just getting serious about retirement, a diversified dividend growth fund built around companies like these, combined with a modest REIT allocation, usually makes a lot more sense than trying to research and manage 60 different stocks by yourself. I'm not telling you which ETF or fund to buy. That's your decision. And it should be. The point is to understand the strategy first, then choose investments that fit your own goals after you've done your research. Once you know where your money is going, you're most of the way there. But there's one thing that can undo all of this surprisingly fast. And it has nothing to do with choosing the wrong ETF. It has everything to do with making one expensive financial mistake. Let's start with the biggest one. I call it the debt leak, because that's exactly what it is. According to Experian, Americans in their 50s carry the highest average credit card balances of any age group, about $9,600. Now combine that with today's typical credit card interest rates, which are close to 22%. That works out to more than $2,000 a year disappearing into interest payments alone. Think about that for a second. Back in scenario 1, Gary needed to invest roughly $1,156 per month to reach his retirement goal. Credit card interest is quietly eating away the equivalent of almost 2 full months of those retirement contributions every single year. And that's before a single dollar gets invested. So if you're carrying revolving credit card debt, paying that off is likely the highest return investment available to you. Not because it's exciting, but because eliminating a guaranteed 22% cost is far more valuable than hoping the stock market delivers a similar return. Next comes another common mistake: chasing yield. Late starters often feel pressure to catch up quickly. That makes high-yield stocks incredibly tempting. After all, if one stock pays 12%, why not buy that instead of something yielding 3% or 4%? Because yields don't exist in a vacuum. A stock yielding 12% usually isn't offering free money. More often than not, it's the market signaling that investors expect the dividend to be cut. Those are called yield traps, and they're designed to look attractive to investors who feel desperate to make up for lost time. The third mistake is panic selling when the market drops. People who sell during a bad quarter don't just lock in short-term losses. They also give up all the compounding that was supposed to happen afterward. And if you're starting at 50, you simply don't have as much time to recover from that kind of self-inflicted setback as someone who started investing at 25. There's another assumption that can be just as dangerous. I'll just work a few more years if I need to. Sometimes that works, sometimes it doesn't. According to the Bureau of Labor Statistics, only about 37% of people aged 55 and older are still participating in the labor force. And when older workers lose their jobs, they typically spend more time unemployed than younger workers before finding another one. Working longer can absolutely be part of your retirement plan, but it shouldn't be your only plan. Now let's go back to the feeling that started this entire video. The idea that 50 is simply too late because someone like Curtis started 25 years earlier. Here's the perspective that changes everything. And it comes from the same actuarial data used to price life insurance and retirement annuities. According to the Social Security Administration's life tables, the average 50-year-old man today has about 29 years of life expectancy remaining. For the average 50-year-old woman, it's almost 33 years. Think about that for a moment. Instead of seeing those years as one long stretch, break them into 10-year chapters. That's not one last chance. That's nearly 3 separate investing cycles, 3 opportunities for your money to compound, 3 chances to steadily build wealth. Curtis may have started 25 years earlier. That's true. But Gary still has enough time for 3 full compounding cycles of his own. The math isn't identical. It never will be. But it's also nowhere near as hopeless as the comparison in Gary's head made it seem. So let's bring everything together. The catch-up runway gives you room to contribute $2,708 per month to a single 401k once you turn 50. And during the special 4-year window between ages 60 and 63, that contribution limit increases even further. The catch-up number turns any retirement income goal into a specific portfolio target, and then into a monthly contribution amount based on where you're starting today. Whether your current balance is $0, $50,000, or $150,000, that starting point can dramatically change how much you actually need to save. The 1990A discount makes REIT dividends more tax efficient in taxable brokerage accounts than many investors realize. And because it's now permanent, it's one less expiration date you have to worry about. The debt leak reminds us that high-interest debt is often a bigger obstacle than getting a late start. Fix that first. Only then should you focus on accelerating your investments. And finally, the 3-cycle clock reminds you that turning 50 doesn't mean you've run out of time. It simply means your first investing cycle starts later than Curtis's did. Let's finish Gary's story. After running the numbers, Gary finally saw his situation clearly. He wasn't starting from where Curtis started. He was starting from where he was. His calculation looked like this: a starting balance of $41,000, a monthly contribution of just over $1,000, 15 years of consistent investing, a portfolio worth roughly $400,000, and around $2,000 per month in dividend income on top of Social Security by age 65. Did Curtis still get there first? Absolutely. But Curtis was never the person Gary actually needed to beat. The real competition was the version of Gary who kept avoiding his retirement account because he believed it was already too late. The moment he stopped believing that, he started moving forward. And that's a race he already won. If you'd like to see which ETFs can help build a portfolio like Gary's without forcing you to research and manage dozens of individual dividend stocks, watch The Best ETFs to Live Off Dividends in America next. It picks up exactly where this video leaves off. And before you go, let me know something in the comments. How old are you? And what's your current retirement balance? Run the numbers we covered today, then share the result you came up with. I read every single comment.